It's a reasonable question. When you look at yields that are 3, 3.5 or 4%, and when interest on cash is paying 5% or even more, a lot of people are asking why even invest in dividends and take the risk if simple cash is paying higher. It's understandable why it's such a common question, however it comes with a deep misunderstanding of why people invest in dividend stocks in the first place. In this video I'll answer the question of why investing in dividend stocks with relatively lower yield can still be worth it, what else you need to look at other than yield, and finally, how long can such high rates on cash really last? Hello and welcome back to the Dividend Experiment, the channel that helps you build a portfolio that pays your bills. The content that we discuss is intended for information and educational purposes only, and should not be considered investment advice or investment recommendation. At the time of making this video, the Bank of England rate is at 5.125%. And as you can see from the chart, this rate is higher, well, quite a lot higher, than it has been for the last 10 years or so. As this is a relatively novel concept for a lot of investors, it causes a puzzling dilemma. On the one hand, where bank rates have been low, dividend stocks have seemed like a natural choice. If your bank barely pays 1%, then a company paying 4% or more seems like a great option to get some income. Now, however, cash is perceived as risk-free in that the nominal amount doesn't go down or you can't lose it on the market, and you know where you stand with the interest. Does that mean that we should all ditch our sub 4% yielding portfolios? Are there benefits to investing in the stock market and risking your portfolio amount going down? Let's take a look. First of all, we'll use 5.2% as the reference point for cash here. There are accounts that have higher amounts, but they usually have some hoops to jump through, such as only being allowed to deposit a certain amount, or moving money around in order to get the bonus, or leaving it locked in place for 1 or 2 years at a time, etc, etc. So we'll base it on 5.2%, as I know that right now you can get 5.2% on uninvested cash with Trading 2. Again, I don't know when you're watching this video, and this rate may have changed in the future, but this is accurate at the time of making the video. And talking of Trading 212, they have kindly sponsored this video. On top of that, I asked Trading 212 if they could give me a unique code that you guys can simply type into the promo code section, capital at risk. So if you've opened up a new account recently or planning to open an account, then here it is, DivXP or DIVEXP, short for the Dividend Experiment. So you have 10 days from opening your account to type this in and receive shares worth up to £100. I also get something as this is my custom code, so this helps you support the channel too. If you do use it, thank you for your support, and thanks to Trading 212 for sponsoring this video. So 5.2% is going to be our benchmark here. You can get 5.2% on cash, the amount you put in won't go down, and you can predict exactly how much you're going to get at the end of the year of holding it. A dividend stock that pays 3% pays less out by the end of the year, and you have no true idea if it will be up or down by the end of the year either. Why would you buy a dividend stock that yields 3% instead of cash? It's because yield is just one part of the equation. There are more factors involved when buying dividend stocks. Let's use a real-world example. ExxonMobil, ticker symbol XOM. Here's an example I found. It's not cherry-picked to prove a point. It's a very common stock that I think dividend investors might probably hold, and it yields about 3%, so it fits nicely as an example, I think. So we have Exxon, which has a dividend yield of 3.14%, and therefore it pays less than the 5.2% cash. If we only look at yield, it's an easy choice. However, here's a couple of things I want to draw your attention to. Let's go back to 2014. Exxon paid $2.76 per year per share. It actually paid out 4 times a year or quarterly amounts of 69 cents, but the total for the year was $2.76. Now in 2024, 10 years later, Exxon now pays $3.80 a share per year, or 95 cents per share per quarter. It's grown over time, and this is the concept of dividend growth. Dividend growth is the increase in dividends paid out by a company over time, indicating its financial stability and performance. This trend is often sought after by investors as it signals a commitment to shareholder value and a potential for future growth of the company. The dividend growth rate, measuring the percentage increase in dividends over time, is a key metric for investors evaluating companies' dividend policies, alongside other factors of course. But again, just yield and dividend growth are not all the factors that need to be taken into account. Now let's go back to 2014 again. Exxon was trading at $96 exactly 10 years ago, and if you wanted to buy it today, it's $121. That means it's increased 25% in that time, as well as paying out the dividends for the whole duration. In fact, just since the start of this year, it's up about 18%. If you looked at yield alone and compared the cash of 5.2% with a yield of 3%, then you would have missed out on the potential for capital appreciation or stock price growth too. Then longer term, the amount each share pays hopefully will increase as well. Comparing yield with interest on cash is too one-dimensional. However, this doesn't guarantee that dividends will perform better than cash. It could be the case that the company cuts the dividends, meaning you actually get less income rather than dividend growth. The company falls in value, so whilst paying you a dividend, the amount that you put into the stock is less than when you started. Obviously, we want to avoid either of these events, and that is part of the trick of investing. In comparison to the cash receiving 5.2%, it's all a trade-off of risk that you're willing to take. If you're planning to keep the money invested for less than 5 years, then the general recommendation is to keep in cash, as there may not be enough time for your investment in stocks to recover if there's a downturn. And this isn't my financial advice to you, by the way, just a generally accepted thought on the difference. How long will these interest rates on cash really last? Now, at the beginning of the video, I said I'd explore how long these unusually high interest rates are likely to last. First, we have to look at what caused that massive change in the graph in the first place. So what caused that climb starting from 2022? Inflation. Imagine the Bank of England, similar to other central banks, has the responsibility of keeping the economy on track. One of the most significant aspects they have to monitor is inflation, which occurs when prices rise over time. Now let's say the price of items such as groceries, clothes and petrol start increasing too rapidly. This could indicate that there's an excess of money circulating in the economy. So what can the Bank of England do about it? Well, one of its tools is interest rates. When inflation starts spiraling out of control, the Bank of England might decide to hike up interest rates. When interest rates rise, borrowing money from banks becomes more expensive. Consequently, people might think twice about taking out loans for things like homes, cars, or launching new businesses. Businesses might also scale back their spending because borrowing money for investments becomes pricier. This reduction in spending and borrowing puts the brakes on the economy. And when the economy slows down, it can help prevent prices from escalating too rapidly. So, by increasing interest rates, the Bank of England can help cool down the economy and keep inflation in check. However, they must be cautious not to raise rates excessively, or they could risk slowing down the economy too much, potentially leading to unemployment or even a recession. It's a delicate balancing act, but it's all part of the Bank of England's job to keep the economy running smoothly. When inflation falls, prices aren't increasing as quickly as they used to. So what does the Bank of England do in this situation? Well, they might decide to lower the interest rates. And when the interest rates drop, borrowing money becomes cheaper, and people and businesses might be more inclined to take out loans for big purchases or investments, because it costs them less to borrow money. With lower interest rates, people might also spend more because they don't get much return from saving money in the bank. This increase in spending can give the economy a boost, which could help prevent prices from falling too much or even stagnating. So by lowering interest rates, the Bank of England can stimulate economic activity and then encourage spending, which helps the economy keep humming along smoothly, especially when inflation is low. However, just like with raising interest rates, they need to be careful not to lower rates too much, or they could risk sparking inflation back again, or other kinds of economic imbalances. So it's all about keeping the right balance. What happens if the Bank of England cuts its rates for our cash? If the Bank of England cuts its rates, then retail banks will follow suit relatively quickly after too. They don't really want to be offering more to the customers on savings than the Bank of England rate. And that means that interest rates fall on savings and savers, and people who want a return on their money need to find somewhere else to put their money. Maybe they turn to dividend-paying stocks again. And what happens when a large amount of money is trying to find a home in a limited amount of stocks? It means that the price of the stocks will go up. That's just fundamentals of supply and demand economics. So saving in cash and being late to interest rates reducing means that you'll also be late once again if you do eventually decide to move back to dividend stocks, as prices will have potentially risen by that point. Obviously, this is some oversimplified economics here and there are way more factors at play, but it makes sense generally speaking. For that reason, my own personal thoughts, and by my own personal thoughts I mean not advice for you, it's just how I think about it. So my own personal thoughts on the cash versus dividends dilemma is, for money that I'll likely need in 5 years or under, I keep in cash that doesn't have hoops to jump through. Right now, yes, trading 2-on-2 seems to me to be a very good choice. For money that I plan to keep invested for longer than 5 years, I'll invest in stocks, using the metronome portfolio. Watch that video if you have no idea what I'm talking about. Finally, I want to talk about something a little higher level here, and I think you'll find interesting, and that's real returns. Real returns refers to the actual increase in purchasing power or wealth that an investment generates after accounting for inflation. In simpler terms, it's the return you get on your investment after adjusting for how much prices have gone up over time. Now, if we return to cash in the bank, when you deposit money in a savings account or similar account at a bank, you typically earn interest on that money. However, historically, the interest rates paid on savings accounts have often been lower than the rate of inflation. So in other words, the money you earn in interest may not keep up with how much prices are rising. For example, if you're earning 2% interest on your savings account, but inflation is running at 3% per year, you're effectively losing purchasing power because your money isn't growing fast enough to keep up with the rising cost of goods and services. This means that even though you're earning interest on your cash in the bank, in real terms, your wealth is actually decreasing because it can buy less and less over time. And this is why financial experts often recommend investing in assets that have the potential to provide returns higher than the rate of inflation over the long term, such as stocks, real estate, or other investments. By doing so, you have a better chance of growing your wealth in real terms and maintaining or increasing your purchasing power over time. Now, I hope that I answered your questions of investing versus high rates of cash, but welcome to ask more in the comments if you still have any. If you liked this video, and if you made it this far, I'm guessing you probably did, then I have some good news for you. I'm giving away my PDF guide to the 10 dividend investing commandments, or the criteria that I use to pick dividend paying stocks, and I'm giving it away to you for free. All you need to do is submit your email in the link below and it'll get delivered to your inbox straight away. Again, that's for free. But that's not the only benefit of joining the email. You also get updates on the almost daily dividend portfolio, interesting stock ideas or news, and special deals and free stuff that I can share with you. Thanks for watching, and I hope to see you on the next video. See you!